Hi, my name is Bryan Mick. I'm the president of Mick Law P.C. in Omaha, Nebraska. Our firm represents several hundred broker-dealers and registered investment advisors, a few family offices. We do due diligence and analyze financials on non-traded investments. Today I'm going to speak about recent legislation, opportunity zone legislation, and then give you a little bit of an update in different asset classes and our firm's collective view on the markets and some of those non-traded assets. I'll speak first off about opportunity zones. There's been a ton of media attention. There's been attention by issuers, lawyers, prospective issuers, lawyers. People in this industry always get excited about a new shtick, a new product, new legislation, but you really need to dig down into the details to understand the opportunity, excuse the pun. The Opportunity Zone legislation was part of the 2017 Tax Cut and Jobs Act, and an opportunity zone is defined as a census tract defined by the governor of a state as eligible to receive private investments through opportunity funds. The opportunity zone uses up to 25% of designated low-income census tracts as eligible properties, and then an additional 5% of real estate or zones. We should say zones because opportunity zone legislation also applies to partnership and corporate investments, not just real estate. But additional 5% can be designated that are contiguous to the primary opportunity zones. We can go through the different strata, the timeline of states identifying their zones, but essentially as of June 18th, 2018, the final submissions were approved by the Treasury Department. Opportunity funds are designed to, or required to hold 90% or more of their assets in eligible opportunity zone property. That is a semi-annual test, at the end of the first 6 months of a fiscal year, which is generally going to be calendar, and then at the end of that year. There is a self-certification process to qualify as an opportunity zone. The taxpayer simply files a form and self-certifies. The real nexus, the real guts of the opportunity zone legislation is treatment of capital gains. If a property, and notice that the 180-day investment time frame is similar or identical to the closing process on replacement property in a 1031 exchange. So an investor has the same time frame involved in designating and investing in an opportunity zone. So after your sale or exchange, you've got 180 days to invest in a qualifying opportunity zone property or fund. And the kicker here is if you hold that investment, you defer capital gains. And I think we'll get into this, but I think this is a common misconception in the investment community. If you hold that investment for a minimum of 5 years, your original basis increases by 10%. If you hold that asset for an additional 2, i.e. 7 total, your basis increases by another 5% of the original basis. So you can defer your original tax bill, and the target date here, the whole central trigger point here is December 31, 2026. So if you hold the asset until that date or later, you defer your capital gains, your basis is increased by 15%, but you still owe tax. And I think that's one point that many people are missing. Then there's the 10-year trigger, and the 10-year trigger allows non-recognition of gain for essentially additional cash in the deal. So if you invested, you had $400,000 in gain that you reinvested in an opportunity zone project, but the minimum investment size, or you wanted to buy extra units, whatever the case may be, you invested $500,000. After settling your tax bill, December 31 of 2026, you have no appreciation, you have no tax on the appreciation of $100,000 new cash that you put in the investment. Same thing for non-1031 buyers. If you go in all cash, you hold it for 10 years. That is true. There is no tax then on the gain as disposed. I think our firm did an analysis. We have a client memo. We did an analysis, and again, I think the opportunities here may be a little bit overstated. It's all about underwriting the asset. You don't go into an opportunity zone deal unless the underlying investment is solid and properly underwrites. And I'm afraid people are just going to buy into opportunity zone funds without doing the homework, without doing the due diligence on whether the investment itself makes sense. I know there are firms out there, quality firms like Peachtree and Arc Trust, who are going to offer opportunity zone investments, but those are assets that they've already underwritten and have under contract or acquired, and have determined on a standalone basis that those investments are quality and will return the appropriate amount of cash and reimbursement of investment to the investors in the deal. So the opportunity zone is really a bonus tax angle to an investment that's already been analyzed. And I think that's where you need to go in on these deals. The thing that concerns me is folks may bid up the real estate in qualified opportunity zones where the investment performance may be offset. The investment performance net tax may be offset by the capital, the additional capital that's deployed because people are chasing assets in these areas. Back to our analysis, our firm did an analysis on traditional straight cash versus putting the identifying an opportunity zone when you have a pending capital gain tax issue. And I think after 5 years on the same asset, the differential in IRR was 20 basis points, and after 10, it was an additional 100 basis points per year. So if you hold the investment for a longer period of time, it becomes material on the return, but maybe not as advertised by many people in the space. We're looking at no less than 3 opportunity zone fund sponsors and their deals at this point. Those have been tabled a little bit to the extent that we're all still waiting on final Treasury regulations. There's not enough regulatory guidance at this juncture to understand what the final rules and the treatment of this investment are going to be. So that's the other thing. People need to back off a little bit. Let's wait till we get Treasury guidance in terms of the regulations that are going to apply under the tax code. So that's the summary on opportunity zones. Yes, it's an opportunity. Secondarily, though, you don't want the tax tail to wag the investment dog. Still needs to be a solid investment. I was asked to maybe give a little bit on state of the markets and other asset classes. As many know, the price of West Texas Intermediate is now, as of yesterday anyway, in excess of $75 a barrel. That's a far cry from the $25 we saw a couple years ago. Consistent with behavioral economics and retail investors maybe buying high and selling low, we have a couple of new energy sponsors that we are reviewing. I think in the crash of the spot price a couple of years ago, the number of folks doing Reg D energy investments decreased by about 50%. Some of that was good, I think, to flush out a couple of marginal players. The folks in the business now are pretty strong. We see, we've talked a little bit about how the opportunity zones play into 1031s. We see some opportunity in DSTs on the royalty side, the working interest side. Those deals are underwriting from a couple of sponsors in the space at generally low to mid double digits. So that's an attractive opportunity. Our theme that we've talked about for years is playing out. Those folks that don't focus on the IDC deduction year one and allow the sponsor to more appropriately and conservatively deploy the capital into lease and drilling assets over an extended period of time, i.e. split that IDC over a couple of years, those folks are doing better from an economic perspective. Again, it's got to be an economic deal. The tax benefits are, cherry on the top. Lots of activity in the DST space, still a strong appetite for multifamily real estate. Our firm has, in our opinions and memos to clients, expressed our concerns on valuation in the brand new Class A multifamily product. We think there's still some opportunity in B and C and workforce housing, but strong activity in the DST space, new entrants that we're dealing with, et cetera. It's no secret, Real Assets Advisor and other folks have almost daily documented the meltdown in the non-traded REIT space. Our concern many years ago, one of our major points of stress was a lot of REIT sponsors don't act like traditional commercial real estate owners and do the fixed amortizing debt when they acquire assets. A lot of LIBOR plus, a lot of floating rate stuff, trying to hit that holy grail of MFFO, AFFO, FFO, whatever you want to call it. Again, an investment theme, whether it's REITs, equipment leasing, or otherwise, that pays out more dollars than the underlying investments generate is generally a bad idea. And there are some, call it REIT 2.0 offerings out there that are, much leaner and meaner. There's been, organizations in this industry who have heavily promoted REIT investments, and investors have suffered. So we're hopeful that is ending. So we've seen a lot of quality Reg D private placements over the last couple of decades. Frankly, with the increase of the accredited investor total to 2,000, we're seeing institutional folks moving into the space doing Reg Ds. The nice thing about Reg Ds is they can be structured and sliced and diced, however is appropriate for the benefit of investors, and we're always pushing for those kind of structures. So that's my recap on opportunity zones. The Mick Law Real Estate Symposium will be coming up October 21 to 23 in Scottsdale, and we will have plenty on opportunity zones, DSTs, conservation easements, development deals, and anything having to do with non-traded real estate. And I thank Real Assets Advisor for having me today. I hope you all have a good week, and we'll see you soon.